how far can we go with this rally?
You know, it just seems that China's been beaten down over the past 2 years. And when we look at the economic fundamentals of China, yes, we have been in somewhat of a recession, but policy-wise, both fiscally as well as monetary, the PBOC is in a very different position to, let's say, other major central banks around the world. So much negative news flow has been now factored into prices. I don't want to just, always talk about just a valuation story, but it just feels that China is likely to have seen its worst, and we're going to see more of a sustainable, maybe a W-shaped recovery, not just a V-shaped recovery.
Okay. Would anything you've heard recently on the reopening or relaxation or recalibration, as policymakers would like to describe that story, or the property, that makes you now rethink the riskiest parts of this equity market, which up until recently, for many, have been hands-off still?
Yeah, I think being contrarian, being diversified in China still makes a lot of sense. We all knew that China couldn't just be isolated or maintain sort of no reopening forever. So it's now appearing to come to fruition. The base case is you'll probably see an increase in numbers in terms of cases over winter. And some cities will be able to implement the 20 measures very successfully. Others will need to catch up. But in general, probably looking at a normalization story in the first quarter, especially March, in terms of living with COVID in the eyes of the Chinese government.
So do you just look at reopening? Do you look at property? What other sectors do you look at?
Well, property is likely to maintain this consolidation phase. So a bit like what we saw in the coal sector 5 years ago. So these state-owned enterprises are likely to benefit. They'll get bigger. In terms of the reopening story, I mean, so many of these names are so cheap. And so local brands, for example, are looking attractive, as well as this premiumization story. But it's not just the Kway Chow Mao Tais in terms of, upgrading. It's also, even brands that can sell a 10 RMB breakfast versus 5 RMB breakfast, so like Yum China, they also look quite attractive too. So don't forget the household savings rate is very high, relatively speaking, over 30%. So it's just that change in sentiment we do need to see from this consumer angle.
Yeah, it feels like it might take time really for the consumer to heal in many ways, right? Mindset and everything. What are the looming risks still, in your view, that when we get moves like this today or like last week, markets tend to overlook? What remains?
We've seen everything pretty much, haven't we, over the past 2 years. If something goes wrong in terms of the pandemic, so all of a sudden there is a new variant which is very, very severe, and China then continues to remain very, very stringent in terms of their policy. We never thought that the property situation would derail China's growth. So again, it's very much a sentiment issue. And even after the Congress, a lot of attention was focusing on all the negative aspects, and no one was really paying attention to the positive growth messaging that came out of the Congress. So again, I think it's just a very, very, underestimated market at this stage. And if we look across Asia, there are other markets that are doing very, very well, where, in fact, they're not pricing, or investors aren't pricing in the potential risk, whether it's political, whether it's, a bit of a hiccup when it comes to the economy. So that's why China's already pricing in so much of the bad news.
Where do you think we'll get the best returns next year, China or the U.S.? Equity.
China. I do think, just because, as I said, fundamentally, everything's sort of in place. We just need to really see a change in sentiment.